Hi everyone, my name is CA Jatin Agarwal, and today in this short video, I will be talking about SPAC listing. Nowadays, frequently you would have heard about a lot of startup companies aiming for US listing, and one of the preferred route which has been followed by them is by way of a SPAC. Now, how does this SPAC listing works? I would like to explain it to you in a very simple manner. So, for a SPAC listing, first you need to have a SPAC. What is a SPAC? Full form of SPAC is Special Purpose Acquisition Company. So this SPAC you need to is basically a blank company which is not having any kind of an operations, and that's first formed. And this has been formed by certain sponsors. Getting your own entity listed as a US entity, as listed in US stock exchanges, first process is you need to find a SPAC. Then the entire game begins. Once you've identified the step, the next step would be to list this particular SPAC. So once you've listed this particular SPAC, this is a blank company. I'll repeat this thing. This is a blank company and you are listing this blank company. Okay. Now, once this SPAC is listed, you have two investors in it. One is the sponsors, right? And then you have public shareholders, right? The next question that comes into everybody's mind is, well, why would a public invest into a company which is blank, right? Which is not having any kind of an operations. Now, this is not a normal offering which has been done. When this IPO is taking place, public is well aware of the fact that they are investing into a special purpose acquisition company. All the money which has been invested by SPAC gets accumulated in a separate account. Okay, the public is well aware that the SPAC is going to find a target, a potential company, okay, where this money is going to get invested into. Okay, so how it works is this public gives the sponsors a horizon of 2 years. Okay, within this 24 months, the sponsors need to find a target basically for this SPAC. And once they have identified this thing, they would communicate this new business or new target which has been identified by them to the public shareholders. If they agree that yes, this is the target that we want to invest into, this is the money, my money should be invested into this particular target, the next steps will come into place. Otherwise, the money would be refunded back to the public. Okay, so kind of a refundable thing which has been given by the public shareholders. Okay, so next step would be to identify a target. Okay, so this target, we have identified a target over here. Now target is this is the holding company for target, and then we have a group entities, right, within the target company. So these are all operating entities. This is also a investment company, right, a holdco of this operating companies, right? And then we have shareholders over here who are existing shareholders of this target company. Okay, now this target company is your company, let's say, and you want to get a US listing done. So what will happen is that if you already have a SPAC which is having a listed shares, the next step and the final step that you're supposed to do is to merge these two entities. Okay, if you merge these two entities, what will happen is you will have a target holding company. You have a target holding company which is having SPAC into it, right? Which is having SPAC into it. Most of these Indian entities, you will see that these target holding companies would be incorporated in Cayman because of the tax favorability over there. But there can be other things also possible. This is just an example which is given over here, right? So target company. Now this target company would have target investors, your target's own investor. You have the sponsored SPAC would also now have investment into it, and the public would also have investment in this. When the public would be having investment in this target company, that means this target company is now got listed. Okay, so when I've merged the SPAC, all the cash which was available in this SPAC account, all the cash which was available in this SPAC company, is blank check company, now also gets available with the target company. Okay, and then they can distribute it to the target group entities who are operating entities, and then the business can be managed as such. Now, one question which comes up to in mind is, how is this magic actually coming up? How is this magic actually done, that we are merging these two entities and then we have this? I'll explain this in a very simple example. Let's say I have a company X, and we have some shareholders who are having this shares of X, right? So, and there's this X company. Okay, now we have a target company, let's say a Y company. let's say, right? And they are public, there are certain shareholders who are holding these shares of Y and controlling this Y entity. Okay, now Y, if Y wants to acquire X, right? Y wants to acquire X by way of merger, right? Why, what when we say merger, what are we actually doing? That means that all of these assets and liabilities of X would come and sit into Y entity, right? When I say this, all of these assets and liabilities of X entity would come and sit into Y entity. These shareholders would suddenly come up, right? And they would say, why are you taking up my all my assets and liabilities? What am I getting in return? The other one possibility is you pay me cash, right? If I don't have cash, the other possibility is that you give me shares of your company. Okay, so ultimately what happens is these X shareholders, these red shareholders, what they will get is these shares of Y, right? So when this Y includes this X, what they have basically done is they have agreed that they would, instead of paying cash, I would be issuing my own shares. Now this Y, which includes X, would be owned by two set of people. One were its own shares, one were its own shareholders, and then is the new shareholders, which are basically having the share of which were basically earlier X shareholders. Okay, so this entire thing gets replicated in this phenomena over here, right? When we have a SPAC and then we have a main entity, target entity, when we merge these two entity, we have this combined entity, and which is owned by two people now, right? One is this targets individual shareholders, these individual, it's targets investors itself, right? And also the public shareholders. So end result is that the target company would have money from the public and the public shareholding, and that's where it is a listed entity. Much, and I hope you find it meaningful. In case of any questions, please feel free to comment in the chat box, and we'll be more than happy to answer those. Thank you.